Most people think real estate makes money only when property prices go up, but that's just Almananisters. But that's just one piece of the puzzle. Rent, appreciation, mortgage paydown, and leverage can all work together. Here's how real estate actually makes money. CJ.
How real estate actually makes money. Have you ever wondered how people become wealthy through real estate? You hear stories about someone buying a house for $200,000, renting it out, and years later owning a property worth $400,000. It sounds simple. Buy a property. Wait. Get rich. But that's not actually how real estate makes money. Real estate can create wealth through multiple different income streams and understanding those streams is what separates a real estate investor from someone who simply owns a house. In this video, we're going to break down exactly how real estate can make money, from rental income and property appreciation to mortgage paydown, leverage, and tax advantages. And by the end, you'll understand why real estate has created so much wealth for investors over the years. Let's start with the most obvious one. Rental income. The first way real estate makes money is through rent. Imagine you purchase a rental property for $300,000. You find a tenant who pays you $2,500 per month. That's $30,000 in gross rent per year. But here's where beginners make a mistake. They look at $30,000 and think, $30,000 a year, that's my profit. Not exactly. You still have expenses. Property taxes, insurance, maintenance, repairs, property management, vacancy, and depending on how you purchase the property, mortgage payments. So what matters isn't the rent. What matters is your cash flow after expenses . For example, if the property brings in $2,500 per month but your total monthly expenses are $2,000, you might have around $500 left. That's $6,000 per year in cash flow before considering taxes and other factors. It might not sound spectacular, but that's only one part of the equation. And this is where real estate becomes interesting. 2. Property appreciation. The second major way real estate can create wealth is through appreciation. Let's say you buy a property for $300,000. Several years later, the property is worth $360,000. You didn't necessarily have to sell anything to create that increase in value. The property itself became more valuable. That's a $60,000 increase in the property's market value. Now real estate prices don't always go up. They can fall. Some neighborhoods perform better than others. Markets can experience major declines. And appreciation is never guaranteed. But historically, long-term investors have often benefited from property appreciation. And here's something important. You can potentially benefit from appreciation while still collecting rent . That means the same property may be producing income today while potentially becoming more valuable over time. That's one of the reasons investors find real estate attractive. 3. Your tenant can help pay your mortgage. Now let's talk about one of the most interesting parts of real estate investing. Mortgage paydown. Suppose you buy a property using a mortgage. Every month you make a mortgage payment. Part of that payment may go toward interest. But another portion can go toward reducing the principal balance. And if you're renting out the property, the tenant's rent may help cover that payment. Think about the long-term effect. You start with a mortgage balance. Month after month, payments are made. Over time, the balance can decrease. Eventually, you could own a much larger percentage of the property outright. So even if your monthly cash flow isn't huge, your net worth may still be increasing because the debt is being paid down. This is something many people overlook. The tenant isn't literally handing you free money. But the rental income can help support the property while the mortgage balance gradually decreases. 4. Leverage. Now we get to one of the biggest reasons real estate can create wealth so quickly, leverage ***. Imagine you have $60,000. You could potentially buy a $60,000 asset outright. Or, depending on financing, you might use that money as part of the purchase of a much more expensive property. For example, imagine buying a $300,000 property with $60,000 of your own money and financing the rest. Now you're controlling a $300,000 asset with $60,000 of your own capital. If that property increases in value by 10%, that's a $30,000 increase in the property's value. Your original investment was $60,000. So a $30,000 increase represents a 50% increase relative to that initial $60,000 before considering financing costs, taxes, selling costs, and other expenses. That's the power of leverage. But there's an important warning. Leverage works both ways. If the property falls in value, your losses relative to your initial cash investment can also become much larger. And you still have to make the mortgage payments. That's why leverage can be powerful but dangerous when used carelessly. 5. Tax benefits. Another reason investors are attracted to real estate is the potential for tax advantages. Depending on where you live, how the property is used, and your individual tax situation, certain expenses related to an investment property may receive favorable tax treatment. There can also be concepts such as depreciation that may allow investors to account for the gradual wear and tear of a property over time. But here's an important distinction. A tax deduction isn't the same thing as free money. And tax rules can be complicated. They depend on your country, state, property type, income, financing structure, and many other factors. So investors should understand the rules and work with a qualified tax professional when necessary. The bigger point is that real estate isn't only about buying and selling. The tax structure surrounding property ownership can also affect the overall return. 6. Valued real estate. Here's another strategy that many successful investors use. Instead of simply waiting for a property to become more valuable, they try to make the property more valuable. Imagine buying an outdated property. The kitchen is old. The bathrooms need work. The landscaping looks terrible. The property might be worth $300,000 today. But after spending $30,000 on improvements, perhaps the property becomes significantly more attractive to buyers or renters. If the improvements increase the property's market value by more than what they cost, you've created value. This is sometimes called a value-add strategy . And it changes the investor's role. You're not simply waiting for the market to make you richer. You're actively trying to improve the asset. 7. Real estate is a business. This is one of the biggest misconceptions about real estate. People think, I'll buy a property and the money will automatically come. But a rental property is often a business. You have tenants. You have maintenance. You have insurance. You have taxes. You have vacancies. You have repairs. You have financing. And sometimes you have difficult situations that require time and money. That's why two people can own similar properties and have completely different results. One investor might carefully analyze the neighborhood, purchase price, rent potential, and expenses. Another might buy simply because they think, real estate always goes up. That's not investing. That's guessing. 8. The real power is combination. Now let's put everything together. Imagine you own a rental property. You receive rental income. At the same time, the property potentially appreciates. Your tenant's rent may help cover operating expenses and debt payments. Your mortgage balance gradually decreases. You may benefit from certain tax treatments. And you can potentially improve the property to increase its value. That's multiple wealth-building mechanisms working on the same asset. And that's the real reason real estate can be powerful. It's not just about rent. It's not just about appreciation. It's the combination . 9. Why real estate isn't easy money. But there's another side to this story. Real estate can also go wrong. You could buy at the wrong price. Your property could stay vacant. A major repair could cost thousands of dollars. Interest rates can affect financing costs. Property values can decline. A bad tenant can create problems. And an investor who uses too much debt can get into serious financial trouble. That's why the goal shouldn't be, how quickly can I buy 10 properties? The better question is, does this property actually make financial sense? Before buying, investors should analyze the numbers. Purchase price, expected rent, operating expenses, financing costs, vacancy assumptions, maintenance, taxes, insurance, and potential returns. If the numbers don't work, the property isn't automatically a good investment just because it's real estate. 10. The bigger lesson. So what can we learn from all of this? Real estate creates wealth in several different ways. Cash flow, appreciation, mortgage paydown, leverage, potential tax advantages, and value creation. But none of these are guaranteed. The best real estate investors don't simply ask, will this property go up? They ask, how does this property make money? How much does it cost to operate? What happens if rent falls? What happens if the property stays vacant? What happens if I have a major repair? And most importantly, what happens if I'm wrong? That's the mindset that turns real estate from speculation into investing. Final thought. Real estate isn't a magic machine that prints money. It's an asset. And like any investment, the result depends heavily on the price you pay, the financing you use, the income it generates, the expenses you face, and the decisions you make. The biggest mistake is thinking that real estate makes money in only one way. It doesn't. A well-managed property can potentially generate income today, build equity over time, and increase in value while you hold it. That's the real power of real estate. So the next time someone tells you, real estate is how people get rich, don't just ask them what property they bought. Ask them, how exactly does that property make money? Because once you understand the answer, you stop looking at real estate as just a house. You start looking at it as a financial asset. If you enjoyed this video, subscribe to *bin invest * for more videos about money, investing, real estate, and building long-term wealth. And remember, don't buy an asset just because you hope it goes up. Understand how it makes money first.